Welcome to the exciting world of peer-to-peer lending, where individuals like you have the power to become lenders and borrowers outside of traditional banking systems. Peer-to-peer, P2P, lending has revolutionized the way people access and invest money, providing a new avenue for financial growth and opportunity. But with every opportunity comes risks. In this video, we'll delve into the risks and rewards of P2P lending, helping you understand both sides of the coin before diving in headfirst. Whether you're considering becoming a lender or borrower through a P2P platform, it's crucial to be aware of what lies ahead. So buckle up as we explore the ins and outs of P2P lending, from understanding its basic principles to identifying potential pitfalls along the way. Let's dive right in. What is P2P lending? P2P lending, also known as peer-to-peer lending or social lending, is a financial practice that connects individuals looking to borrow money with those willing to lend it. It cuts out the middleman, traditional banks, and allows borrowers and lenders to interact directly through online platforms. In this digital age, P2P lending has gained significant popularity due to its potential for higher returns compared to traditional savings accounts or investments. Lenders can earn interest on their loaned funds, while borrowers can access financing at potentially lower rates than what they might find at a bank. The process typically starts with a borrower submitting an application and providing necessary documentation through the chosen P2P platform. The platform then assesses the borrower's creditworthiness using various criteria such as income verification, credit history, and other relevant factors. Once approved, the borrower's loan request is listed on the platform for potential lenders to review. Lenders have the opportunity to evaluate different loan listings based on risk level, interest rate offered by borrowers, and other available information before deciding which loans they want to fund. When enough investors commit funds towards a particular loan listing, often referred to as loan funding, the borrowed amount is transferred from lenders' accounts into the borrower's account. From there on, borrowers make regular payments until they fully repay their loans along with accrued interest. Peer-to-peer lending offers numerous benefits for both parties involved. Borrowers often appreciate faster approval processes compared to traditional banks and may find more flexible terms tailored specifically for their needs. Lenders enjoy potentially attractive returns on their investment capital by diversifying across multiple loans within their risk tolerance levels. It's important to note that P2P lending does come with certain risks too. We'll explore these in detail later in this post. As with any financial endeavor, it's crucial for participants in P2P lending platforms to conduct thorough research and exercise caution when making decisions about borrowing or lending money. Now that we have a basic understanding of P2P lending, let's move on to the risks and rewards of P2P lending. The risks and rewards of P2P lending. P2P lending, also known as peer-to-peer lending, has gained significant popularity in recent years as an alternative investment and borrowing option. It allows individuals to lend money directly to other individuals or businesses through online platforms, eliminating the need for traditional financial institutions. One of the major rewards of P2P lending is the potential for higher returns compared to traditional investments. With interest rates often exceeding those offered by banks or other investment vehicles, lenders can earn attractive yields on their investments. This can be especially appealing for investors looking for ways to diversify their portfolios and generate passive income. However, it's important to note that with higher returns comes increased risk. One of the main risks associated with P2P lending is the possibility of default by borrowers. While platforms typically have mechanisms in place to mitigate this risk, such as credit checks and loan screening processes, there is still a chance that borrowers may fail to repay their loans. Another risk factor is liquidity. Unlike stocks or bonds which are traded on established markets, P2P loans can be illiquid and difficult to sell before maturity. This means that if you need access to your invested funds before the loan term ends, you may face challenges in finding buyers willing to purchase your loan notes. Additionally, regulatory risks should be considered when investing in P2P lending platforms. As this industry continues to grow and evolve, governments around the world are implementing regulations aimed at protecting both lenders and borrowers. These regulations could impact how these platforms operate and potentially affect investor returns. In conclusion, not concluding, while P2P lending offers enticing rewards such as potentially high returns and diversification opportunities, it also carries its fair share of risks including borrower defaults, illiquidity concerns, and regulatory uncertainties. As with any investment decision, thorough research and due diligence are crucial when choosing a platform and assessing its associated risks. How to choose a P2P lending platform. When it comes to choosing a P2P lending platform, there are several factors you should consider. First and foremost, you need to research the reputation and track record of the platform. Look for platforms that have been in operation for a significant amount of time and have a proven track record of successful loans. Next, take a close look at the loan offerings on the platform. Consider factors such as interest rates, repayment terms, and borrower profiles. Make sure that the loan options align with your risk tolerance and investment goals. Another important factor to consider is the level of transparency provided by the platform. Look for platforms that provide detailed information about borrowers, including their credit history and financials. Transparency is key when it comes to assessing risk. You should also evaluate the platform's underwriting process. Find out how they assess borrower creditworthiness and what criteria they use to approve loans. A robust underwriting process is crucial in minimizing default risk. Don't forget to review any fees associated with using the platform. Some platforms charge origination fees or investor service fees, which can eat into your returns over time. By carefully considering these factors, you can choose a P2P lending platform that aligns with your investment goals while managing potential risks effectively. Conclusion: P2P lending offers both risks and rewards for investors and borrowers alike. It provides a unique opportunity to connect individuals and facilitate borrowing without traditional financial institutions in the middle. However, it's important to understand the potential pitfalls that come with this type of lending. When considering P2P lending, it is crucial to carefully assess the risks involved. Default rates can be higher compared to traditional loans, so diversifying your investments across multiple borrowers is key. Additionally, there may be limited regulatory oversight in some countries or regions, which could expose lenders to fraud or other illegal activities. On the flip side, there are several attractive rewards associated with P2P lending. For borrowers, accessing funds quickly and easily can be a game changer when facing financial challenges or pursuing entrepreneurial ventures. Investors also have the potential for attractive returns by earning interest on their investments. To choose a reliable P2P lending platform that suits your needs and mitigates risks. 1. Research. Look for platforms with a solid track record and positive reviews from users. 2. Security measures. Ensure that the platform utilizes robust security measures such as encryption techniques to protect user information. 3. Transparency. Choose platforms that provide comprehensive information about loan originators' track records as well as borrower profiles. 4. Diversification options. Option for platforms that offer diversification tools allowing you to spread your investment across different loans or risk categories. 5. Loan default management. Assess how each platform handles loan defaults and what steps they take towards recovery. While P2P lending presents exciting opportunities for both lenders and borrowers, it does carry inherent risks that require careful consideration before diving in headfirst. By conducting thorough research into reputable platforms and understanding how to manage these risks effectively through diversification strategies, investors can reap the rewards offered by this innovative form of alternative finance while minimizing potential downsides.